Intro: The silence before the damage. There are moments in history when a crisis announces itself loudly. Markets crash, banks fail, screens turn red. This is not one of those moments. What is happening now is quieter, slower, and far more dangerous, because it is happening inside the lives of millions of Americans, and almost no one is talking about it. This is the story of America's student debt system, not as an education problem, not as a moral debate, but as a structural financial failure. Part 1. A number that should not exist. Let us begin with a single number: 3.62 million. That is how many Americans are now classified as severely delinquent on their student loans. This does not mean late. It does not mean forgot to pay. It means these borrowers are over 90 days past due. Many are over 271 days late. In financial terms, they are already falling. What makes this number extraordinary is not just its size, it is the comparison. Before 2020, the number of federal student loan borrowers this late was relatively stable. Today, it is 8 times higher than the pre-2020 average. 8 times. Economies do not survive 8-fold failures without consequences. Part 2. Worse than the crisis that broke the world. Now we move to a statistic that should stop every economist in their tracks. As of 2025 to 2026, 14.3% of all student loans are now 90 days or more delinquent. This is not just a record, it is historically extreme. To understand what this means, let's compare it to moments when the global financial system nearly collapsed. During the 2008 global financial crisis, delinquency peaked at 7.5%. In 2013, after years of damage, it reached 10.5%. Today, 14.3%. Student loan delinquency is now nearly double what it was at the height of the worst financial crisis in modern history. And unlike mortgages, student loans do not go away. Part 3. The illusion of stability. For years, the system appeared calm. Payments were paused, defaults disappeared, delinquencies fell. Many believed the problem had been solved. It had not. It had been hidden. The U.S. government introduced an on-ramp period, a temporary phase where borrowers who missed payments were not reported to credit bureaus. No credit damage, no consequences, no visible stress. It was not recovery, it was suspended gravity. And in June 2025, gravity returned. Part 4. When reality resumed. Once the on-ramp ended, missed payments began appearing on credit reports. FICO scores dropped fast. Loan approvals tightened. Interest rates surged for those who could still borrow. For millions of borrowers, there was no gradual adjustment, there was impact. Years of financial pressure arrived all at once. This is what happens when policy delays reality instead of fixing it. Part 5. This is not a youth crisis. This is not about reckless teenagers. This is not about recent graduates. A large share of delinquent borrowers are in their 30s, in their 40s, in their 50s. They carry student debt alongside rent or mortgages, medical bills, family expenses. This debt was supposed to expire with opportunity. Instead, it matured into a permanent liability. Part 6. Credit as a control system. In the modern American economy, credit is not optional. It is the gateway to participation. When student loans go delinquent, credit scores collapse, insurance premiums rise, employment background checks become harder, housing options disappear. A low credit score is not a punishment. It is economic exclusion, and exclusion spreads quietly. Part 7. The consumer economy under pressure. The U.S. economy depends on consumption. Not innovation, not exports. Consumption. When millions of people are locked out of credit, forced to prioritize debt survival, unable to plan long-term, spending slows. Not suddenly, not dramatically. Gradually. This is how recessions begin without panic. Part 8. Why this crisis is harder to fix. In 2008, debt was attached to assets. Homes could be sold, banks could be recapitalized, losses could be written off. Student debt is different. You cannot repossess education. You cannot bankrupt knowledge. You cannot reset human capital. This debt lives inside people, which means its damage persists as long as they do. Part 9. The political deadlock. Forgiveness angers voters. Enforcement hurts growth. Delay worsens outcomes. There is no clean solution. So the system drifts. And drift is not neutral. Drift always favors collapse. Part 10. The Stoic conclusion. Stoic philosophy teaches a simple rule. Reality does not care about what should have been, only about what is. And what is a generation weighed down by debt that no longer produces growth. The student debt bomb has already exploded. There will be no single crash, no dramatic headline, no moment of recognition. Only a slower, colder truth. An economy cannot thrive while millions are quietly sinking. Part 11. What comes next? The future unavoidable. The most dangerous question is not what happened. It is what happens next. Because systems do not collapse all at once, they progress through stages. And the student debt system is already past the early ones. Stage 1. Normalization of default. The first thing that will happen is not panic, it is normalization. As delinquency rates remain elevated, default stops being shocking. It becomes common, routine, expected. Credit agencies adjust their models. Banks quietly tighten lending standards. Borrowers learn to live with damaged credit. This is not recovery. This is adaptation to decline. Stage 2. Credit restriction spreads. Student loan delinquency does not stay isolated. It bleeds outward. Auto loans become harder to get. Mortgage approvals slow further. Small business credit thins out. Not because banks want to punish borrowers, but because risk models no longer allow generosity. This is how a debt problem becomes a credit contraction. Quietly, systematically. Stage 3. The consumer economy softens. At this stage, policymakers will notice something strange. Inflation may cool. Employment may look stable. But spending weakens anyway. Why? Because millions of Americans are no longer planning futures. They are managing survival. No new cars, delayed home purchases, fewer family expansions. The economy doesn't crash, it loses momentum. Part 4. Policy response. Too late. Eventually, pressure builds. Calls for reform return. Forgiveness debates reappear. Temporary relief programs are proposed. But the timing is wrong. Once credit damage is widespread, relief becomes expensive and politically toxic. Policymakers will likely choose delay disguised as reform. Extensions, deferrals, rebranding, not resolution. Stage 5, a permanent class of borrowers. This is the most uncomfortable outcome. A permanent class of Americans with chronic student debt, impaired credit, limited economic mobility, not poor enough for emergency aid, not solvent enough to participate fully. This is not a collapse you see. It is a future you live inside. What will not happen? Let's be clear about what is unlikely. There will be no clean bailout, no full reset, no dramatic forgiveness moment. Large systems rarely admit failure. They absorb it and spread the cost.